Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Bonjour. Welcome to Cut to the Chase. This is Daniel Lam, your host for the podcast. Now, one of the toughest situations for investors is how a previous trend has been turning against them. And what they need to do is to assess, A, whether this previous trend would indeed be returning, in which case they should be adding to their exposure. Or B, the prices keep going against them, in which case they would need to be looking at risk management there. Now today, we are going to focus upon one such investment, which is oil. Firstly, we are going to look at the reasons behind the recent weaknesses in oil. After that, we're going to look at oil technicals. And finally, we are going to see how oil may be doing in the future. First of all, greater supply is the key reason behind oil's recent weakness. A resumption of the Druzhba pipeline, which supplies oil from Russia to Central Europe, weighed on oil prices. OPEC Plus agreed earlier this month to increase oil production by 100,000 barrels per day from September. In the US, oil inventories surprised to the upside, rising by more than 2 million barrels earlier this month versus an expected drop, and that likely owing to greater supply and fears of recessionary demand destruction. There's also progress on the Iranian nuclear talks also. So those were the supply factors. Now on the demand side, China data has been below expectations. So all these combined together partially ease concerns of a tight demand-supply balance in oil markets. On to the technicals. So oil has been falling from just over $120 in June to the current level below $90, making lower highs and lower lows, which is a bearish technical trend. It has fallen below our previously highlighted support of $93. Now, when combined with recent data, this arguably raises the risk of prices falling further in the short term. So the key support level for you to watch is $82, which we're expecting that to hold, while a break above $105 is likely needed for the near-term downtrend to fade. Now, on to the most important part. How do we see oil prices going forward? Well, on a longer 6 to 12 month horizon, we stay constructive in oil due to several factors. First of all, the chronic underinvestment in the sector. Secondly, we see limited spare capacity. And thirdly, the geopolitical risk premium is still on the high side. In terms of energy equities, so global energy continues to be a key preferred sector of ours, where earnings have continued to beat expectations, and energy equities prices still lag the rise in oil prices on the longer term. A potentially more favorable mix of inflation versus growth may help alleviate some of the concerns on the demand side of oil. That's all from me today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.